Are you thinking of selling put options for weekly or monthly income? If so, you've come to the right place. In this video, I'm going to be talking about selling put options, what they are, what you need to know, how they work, and the steps that I use to sell them. Also, I'm going to show you the one thing you must avoid when selling put options. I promise, if you skip through it, you could lose a lot of money, so stay tuned. I'm also going to give you a bonus, a plan B, to reduce your risk and potentially make even more money selling puts. Now, before I get into it, I want you to know that I am not an investment banker, a financial advisor, an accountant, or in any way licensed to provide financial or investment advice. Actually, I'm just a high school dropout who learned how to invest and save and eventually retire from a day job at 35 years old 7 years ago. So everything I talk about in this video is for entertainment purposes only, because like I always say, invest with a trusted investment advisor. But at least by the end of the video, you'll have a better idea about another way to earn weekly or monthly income. And then you can discuss the method with your investment advisor to see if the plan is right for you. Now, if you're new to the channel, my name is Rick Orford, author of The Financially Independent Millennial. And if you like videos about investing or making money or even retiring early, now is a great time to hit the subscribe button. That way you won't miss my next video. Oh, and before I forget, this video is brought to you by thefinanciallyindependentmillennial.com. It's my blog where you can learn to save, invest, and become financially independent and retire early. Now, you might be wondering, what the heck do I know about selling put options? Well, I've been active buying and selling stocks and options for nearly 20 years. And you know, buying and selling stocks can be complicated enough. And selling options is a strategy that investment bankers generally use, or those who are super savvy, but it doesn't have to be that way. Now, you may have heard of selling covered calls, and you might already be doing this. Actually, I think selling covered calls could be one of the safest way to invest. But selling put options is different. It's different because, unlike with selling a covered call, you don't have to own the commodity or the stock. Some say it's very risky. I think it's no different than owning the stock itself. But in order to be successful with any investment strategy, you have to understand the risks. And I'll go over all of that today. First, it's essential to know what an option is. A put option is a contract between a buyer and a seller that specifies 4 things: rights and obligations, the underlying security or commodity, the expiration date, and the strike price. And with a put option, the seller sells the option to a put buyer. And the put buyer gets the right, but not an obligation, to sell an equity or commodity to the option seller within a specific time period and at a set price. In other words, the put seller might be required to buy something from the put buyer should the buyer decide. And the put option specifies what that something is: the underlying security or commodity, along with a strike price and expiration date. So the buyer has the option to exercise his or her right at any point until the contract expires. So let's consider the following example between Jimmy and Sally and coffee beans. Jimmy has a warehouse full of coffee beans, and Jimmy is worried the price of coffee could go down in price. So he wants to protect his stash of coffee. Sally, though, she isn't so concerned. Sally buys coffee regularly and thinks the price of coffee is pretty stable or might go up, but not too much over the next month. Today, coffee beans cost $10 a pound, and Sally decides to sell an option contract to somebody that goes like this. Sally sells a contract to Jimmy, the buyer, who will have the right but not the obligation to sell her some coffee beans for $10 a pound, at any point until the contract expires in 1 month. And Sally offers this contract for $1 a pound, and the contract's for 100 pounds, so she gets $100. Confused? I was too, when I started learning about selling put options. Let's go over it one more time. Sally sells the contract to Jimmy. So Sally is the put seller who might buy Jimmy's beans if he decides it's worth it. Now you might be wondering, why would somebody want to buy such a contract? Well, Jimmy has a warehouse full of coffee beans, and he wants to protect his investment. So if the price of beans goes down, Jimmy can sell those beans to Sally for a higher price, the price that's specified in the contract. So Jimmy agrees, and he's willing to sell Sally 100 pounds of his coffee beans for $10 a pound at any point until the contract expires next month, if he wishes. And he pays Sally $1 a pound, or $100 for this option. And that option is called a put option. So Jimmy paid Sally $100 for this option. And the $100 is called the option premium, or the income that Sally gets to keep no matter what happens to the price of coffee beans. Fast forward next month, and we have 3 possible scenarios. Scenario 1, the price of beans goes down to $8 a pound. Well, Well, Jimmy is happy because now he can sell 100 pounds of his coffee beans to Sally for the contracted price of $10 a pound, because now they're worth $8. So Sally pays Jimmy $1,000 for the beans, even though they're only worth $800. But she did collect $100 from Jimmy earlier. So for Sally, it's a bit of a loss, but it's not the end of the world. Scenario 2. At expiration, coffee beans still cost $10 a pound. Bean prices were pretty stable, so the option expires worthless. Now, if Jimmy wants, he could sell Sally the coffee beans, but there'd be no real reason to do so because the price is still $10. He could sell the coffee beans to anyone for the same price, or he could just keep them. But Sally gets to keep her $100. Scenario 3. The price of coffee beans goes up to $12 a pound, just as Sally predicted. Whoa, well, now what? Well, remember, the contract says Jimmy can sell Sally 100 pounds of coffee beans at any point before the expiration date for $10 a pound. Well, why would he do that now? If Jimmy wanted to sell his coffee beans, he could sell them to somebody else for $12. So again, the option expires worthless. And that's what every option seller wants. Either way, Jimmy loses his $100, but Sally is happy because regardless, she got to keep her $100. And Jimmy is happy because coffee costs $12 a pound. So who would you rather be, Jimmy or Sally? So you see, people buy put options as a form of insurance against the price of an underlying equity or commodity going down. And the put seller assumes all the risk, but gets to keep all the income. Give me a like if you thought this cartoon was helpful. It'll give me a sense of whether or not I should be using one again in a future video. And I hope it wasn't too confusing. If it was, take a moment. Go ahead and pause the video, because with the magic of YouTube, you can watch it again. Now, I'm going to talk about some real-world examples about how you can start making weekly or monthly income by selling put options. First, remember, options are just contracts that have rights and obligations. For example, those who buy put options have the right to sell something specific to the option seller at any point before the option contract expires at a specified price, the strike price. And in exchange, the put seller collects an option premium, the income, from the buyer. And this premium is guaranteed income that the put seller gets to keep every time they sell options, regardless if they're weekly, monthly, or even yearly. Yes, you, the put seller, can repeat the trade again and again, week after week, and month after month, and keep the income no matter what happens. But like any investment, you'll need to know some basic things about selling weekly or monthly put options for income. In particular, it's important to understand the mechanics, the rights, the obligations, and the overall risk. Typically, retail investors like you and I buy and sell put options on equities like an index ETF, not on commodities like coffee beans. Though I like the coffee example because to me, I love coffee, so I can relate, at least just a little. One of the things people often sell puts on is the SPY. The SPY is an ETF. It's the most famous S&P 500 index ETF, and it works like this. One put option on the SPY allows the put buyer the option to sell the put seller 100 shares of the SPY ETF for a specific price known as the strike price before the expiration date. And that's all. And the seller collects the income, the option premium for selling the put option. So what do you need to sell put options? Well, remember, when selling a put option, you're giving the buyer a right, but not an obligation to sell you the underlying commodity or security. In other words, you may need to be able to buy the underlying commodity or stock or ETF, so you'll need enough collateral. Collateral will be in the form of cash or margin in your brokerage account. Remember, you, the put option seller, agree to buy something specific in the future if the buyer requests it. So your brokerage account needs to have enough money or collateral for you to afford the purchase. For example, if you want to sell one put option on the SPY, you'll need to be able to buy 100 shares of the SPY ETF in your brokerage account at the specified strike price. If the strike price is $300, then you'll need to be able to afford to buy $30,000 worth of SPY. And of course, if you want to sell 5 put options and earn 5 times the money, well, you'll need to have enough cash or margin available to purchase 500 shares of the SPY in your brokerage account. Also, options typically expire on the 3rd Friday of each month. However, many stocks and ETFs now offer a wider range of expiration dates. For example, the SPY has options that expire on Mondays, Wednesdays, and Fridays of each week. In other words, you could start selling weekly put options and collect income as much as 3 times a week, every week. In general, you can earn anywhere between 1% and 5% or more a month selling weekly or monthly put options. It all depends on your trading strategy. How much you earn depends on how volatile the stock market currently is, the strike price, and the expiration date. In other words, the more risk you're willing to take, the more income you'll collect. Similarly, the more unstable the markets are, the greater the income. To give me the most amount of income, I prefer selling put options slightly out of the money, with an expiration of 3 to 6 weeks out. An out-of-the-money put option means the strike price is lower than the underlying security. Now, you might be wondering about the risks of selling put options. First, you must remember that by selling weekly or monthly put options, you agree to buy the underlying equity should the put buyer wish at any point until expiration. So to manage the risk, you need to be sure that whatever you're selling a put option on, that it's a quality stock or ETF that you'd be happy to own at the agreed strike price. And once you own it, you can do whatever you like. Let's look at a real-world example. Let's talk about Apple. Let's say Apple is currently selling for $130 a share, and you think Apple is on its way up. So you decide you want to sell a put option with a strike price of $130 that expires next month, say July 17th. And your brokerage tells you that investors are buying the option for $4. So if you sell this put option, you'll collect $4 of income times the number of contracts you trade times 100. So if you sell one contract, you'll get $400 of income or option premium that you can keep no matter what happens. It's the guaranteed income. Now, let's fast forward to the expiration date. Let's say Apple is now trading at $120. In this case, you'll be forced to buy 100 shares of Apple for $130 each, even though they're only worth $120. But don't forget, you've already collected $4 for the put option. You'll only lose if you sell the Apple shares at a loss. Now, let's examine two more exciting scenarios. Let's say that on expiration day, Apple didn't move very much, and it's still selling for $130. Remember, you'll be profitable as long as Apple stays above the strike price, so in this case $130. Since $130 is the same as the strike price, it means nothing happens. The put option expires worthless, which is what you want. And of course, you get to keep your $400 of income, and you can repeat the trade next week, next month, or next year. And finally, the same will happen if the shares go up in value, above the strike price. The option expires worthless, and you get to keep the $400 of income no matter what. Now, remember earlier I mentioned I'd give you that one thing that I think you should not do when selling put options? Well, here we go. Selling put options is a guaranteed way to earn weekly or monthly income. And yes, it can be very profitable month after month. The key is to remember to sell put options only on high quality equities or ETFs that you would actually want to own, because you may be forced to buy them. And you might be wondering if you can lose money selling put options. Well, you'll never lose the income from selling put options. The income you receive from selling puts is guaranteed. However, if you're forced to buy the underlying equity and you sell the underlying equity at a loss, then yeah, you may lose money. And last but certainly not least, I wanted to give you a plan B, something else that you can do to reduce your potential risk or make even more money selling put options. Here it is. When you sell a put option, if the equity has gone up considerably, your option will likely be profitable. So you could always close out your trade by buying back the identical option at a lower price. Now, why would you want to do that? Well, then you could sell another put option and repeat the process. Folks, if this is your first time thinking about selling put options, I know that you might be confused. I know that I was. So if you're still confused, go ahead and watch this video a few more times. By the way, which tip did you like the most? And do you already sell put options? Let me know in the comments below, because I'd love to hear from you. In the meantime, stay safe, and I'll see you in the next video. Bye.